Hello and welcome to Everyday Oral Surgery. This is your host, Dr. Grant Stucki. I am an oral and maxillofacial surgeon practicing in Denver, Colorado. The goal of this podcast is to connect, learn, and inspire. In this podcast, you'll be hearing from OMS surgeons all over the globe discussing ways to improve the practice of oral and maxillofacial surgery. Most information shared in this podcast will be based on personal experience and opinions, so please supplement what you learn here with approved research studies. Without further ado, please enjoy today's episode. Welcome back to another episode. Today I'm with Brannon Moncrief. He is the principal and CEO of McLerran and Associates. Helps a lot of surgeons every year with their processes of buying, selling practices. So I wanted to get you on the podcast, Brannon, and talk to you. How are you doing?
Good. Thanks for having me, Grant.
Yes. Can you give us just a little kind of brief background of your business and your kind of business background?
Absolutely. So I've spent the last 25 years, my entire professional life, on the business side of dentistry. I spent about a decade lending money to dentists and specialists to acquire and start practices. And then 15 years ago, I purchased McLerran and Associates. So McLaren's been around for 35 years. And for the first, let's call it 28 years of the company, we specialized in doing traditional practice sales, brokerage and sell-side advisory for doctors that were selling their practice for one reason or the other and transitioning it to another clinician. So I bought the company 15 years ago and substantially scaled that doctor to doctor side of the business. We're based in Texas. I live in Austin, Texas, but we now have offices all across the country in LA, Austin, Cleveland, Washington, D.C., and Atlanta. So truly serve dentists and specialists nationwide. And we provide sell-side advisory. So we help them understand the value of their business and the options for monetizing their business. As I talked about, first 28 years of the company, we're focused on exclusively doctor-to-doctor traditional practice sales. But being in Texas about 7 years ago, we were on the forefront of a lot of the DSO consolidation that started to occur. This new wave of consolidation that back then was, kind of led by Heartland and then had many others follow suit. So we were watching some of the doctors that, owned larger successful practices choose to sell to a DSO or private equity rather than sell to another clinician. And we realized that we needed to get involved in that space and build out a team, build out a process to represent larger practice owners who are, for one reason or the other, going to decide to sell their practice to a DSO or private equity. So fast forward 7 years later, we've completed about 250 DSO and private equity transactions exclusively in the dental space and worked with a lot of oral surgeons. So it's great to be on this podcast because I think it's timely. I mean, arguably, oral surgery practices are the hottest asset that DSOs are buying. They garner the highest level of demand from DSO buyers, as well as the highest multiples and the highest cash at close. So it's been fun, playing in this sandbox over the past 7 years and seeing the outcomes that we help our clients achieve. But at the end of the day, our job is to educate practice owners regarding, what's their business worth, help advise them regarding what are their options to monetize it, and then when they're ready to go to market, create a highly competitive environment, create as much competition and leverage as possible to help them find the right fit, right? The right partner, and negotiate the highest valuation and most attractive deal structure we possibly can.
Got it. Okay. So that's basically the role that you guys play in the DSO affiliation process. I mean, anything else to add in that?
No, I mean, the goal at the end of the day for everybody, everybody's going to sell their business at some point, right? That's inevitable. Death, taxes, the sale of your business. Three things that everybody's going to eventually go through. So I think it's critical to understand what your EBITDA is, what your business is worth, what your options are, and then, look up every few years as you reach different inflection points in your personal life, your professional life, the growth of your business, and decide, when is the appropriate time to sell the business to maximize your outcome, and then, what are the options available to you?
Yeah, for sure. That's a great point. So, we recently had an episode. We're kind of doing this series on various perspectives, and we had one that was looking at the side of kind of not selling and keeping your practice and the pros and cons of that. In your view, why are so many oral and maxillofacial surgeons deciding to affiliate with DSOs and private equity groups over the past, 5 to 10 years?
Yeah, great question. And I want to make the point that we're not necessarily pro DSO, right? The legacy business is built on that traditional practice sale, the doctor to doctor deals. I will say that oral surgery practices in the private buyer space, selling your oral surgery practice to another clinician when you're ready to monetize the business or exit the business has become exponentially more difficult over the past decade. I mean, most oral surgeons that are coming out of residency in today's environment are either going to go work for a DSO, right, for a big guarantee, or and or big company benefits, or they're going to start their own practice from scratch. And most of them are relatively confident that they can get to $2 million in revenue and a substantial personal income on a relatively short runway. So for that reason, it's gotten more and more difficult to monetize an OMS practice in the private buyer space. And the multiples that they trade for in the private buyer space, whether we're talking about a multiple of EBITDA or a percentage of revenue, are highly depressed comparative to what these practices are currently trading for on the DSO market. But there's numerous reasons why an oral surgeon may decide to sell to a DSO. For a lot of our clients, their practice is their most valuable asset, and it's got a tremendous amount of key man risk. And they want to de-risk, take some chips off the table, and diversify their wealth across other asset classes, right? So monetizing, 70, 80% of the business, pulling that money out of your practice and then diversifying it across other asset classes definitely has significant value. A lot of people are looking for operational help, especially post-COVID, the staffing crisis that we've all been privy to, as well as just you've got to be a more dynamic operator and business owner today to own and operate a profitable business comparative to the previous generation of oral surgeons. There's just a lot more hats that you have to wear and that you have to perform at a high level on a daily basis to run a well-owned, well-operated business. So those are the two primary reasons that we see. I mean, it's the monetary aspect, right? The fact that practices are trading for a significant premium and are liquid in the DSO market compared to selling to another clinician, diversification of wealth and de-risking, along with getting some operational help. And then lastly, the wealth creation opportunity that comes along with the equity component. While the equity does have risk, it has significant upside. And particularly in the specialty space, in the OMS space, we have seen the highest returns on DSO holdco equity and the most liquidity comparative to the other specialties and general dentistry. A lot of the OMS platforms have seen recaps at substantial multiples, 14, 15, 16x with significant liquidity on that equity, over the past 5 to 7 years.
Nice. And are you currently seeing, I mean, is this year the same significant demand for OMS practices from DSO buyers? Has it cooled off? Is it heating up more? Do you have a pulse on that?
So as a whole, the dental marketplace has cooled since its peak in 21 and 22. Valuations really hit their peak because of the macroeconomic environment. Coming out of COVID, dentistry had proven to be recession-proof multiple times. Then it proved to be pandemic-proof. Private equity already loved dentistry and was pumping a lot of money into the consolidation of the space. And then coming out of COVID, we were still in an ideal macroeconomic environment, right? Historically low interest rates, the capital markets were wide open. A lot of OMS platforms recapped at 14, 15, 16x in that 2 to 3 year period of time. And as a result, the market was super frothy. The market as a whole has cooled off a little bit over the past few years, but I would argue that OMS practices have withstood that cooling period better than any other dental focused vertical. So you're still seeing elevated demand. There's been quite a few newer OMS platforms come to fruition over the past few years. So you've got more OMS focused buyers than ever before. You've got some multi-specialty buyers that are interested in the OMS space. And then you've got some general dentistry buyers are now expanding into specialty in markets where they have density. So I would argue that as far as the number of buyers that are buying in the OMS space, at an all-time high and valuations still hovering around an all-time high.
Nice. And can you talk to us about EBITDA? Which we'll just review kind of what it stands for, and how that plays into the sale of a practice.
I mean, at this point, most people that own a successful practice know what EBITDA is because it's been a huge talking point in our industry for the past 7 years as private equity has come into the space. EBITDA stands for earnings before taxes, depreciation, and amortization, interest, taxes, depreciation, and amortization. Essentially, think of EBITDA as absentee owner profit, right? Once all the true overhead of the business is paid, after removing all of the discretionary, personal, non-recurring expenses from the P&L, and after assigning an appropriate market wage to the doctor to produce the dentistry, what is the, say, passive net profit for the investor at the end of the day? That's really what EBITDA is. And private equity values OMS practices through the lens of a multiple of EBITDA. So every dollar of EBITDA for an OMS practice is worth somewhere between $7 to $10 in value. So the most impactful thing when we talk about the value of dental practices is EBITDA. Multiples matter, but the EBITDA matters more than the multiple. And that's a big part of our job. That's why we have a CPA on staff. That's why we have financial analysts on staff, is controlling the narrative regarding EBITDA and ensuring that our client gets credit for the highest EBITDA level possible, and then leveraging that competition in the marketplace between multiple buyers to create a multiple offer situation in what we call a blind bid process, to leverage them against each other to also increase the EBITDA multiple. So if we can get credit for a higher EBITDA level and leverage competition to garner a higher EBITDA multiple, it creates an exponentially higher valuation and economic outcome for the client.
Got it. Okay. So that definitely makes sense on how involving McLerran and your group could boost like a return on the sale of your business.
Absolutely.
Yeah. Can you tell us a little bit about like the general DSO deals, how they're typically structured, things like that?
Great thing about the fact that your listeners own, OMS practices, and those are the most highly garnered assets today in the dental market, is the deal structures are more attractive and a lot cleaner typically in the OMS space comparative to some of your peers and other specialties, certainly your peers in the general dentistry space. You're typically talking somewhere in the range of 70 to 80% cash at close. So significantly higher cash at close than your peers would typically achieve. And the remainder is normally holdco equity. So equity in the parent company of the DSO. So you're basically investing alongside, the private equity sponsor or family office that backs that DSO, with the hope that, assuming they're successful financially, that equity will significantly grow in value, potentially double or triple in value over a 3 to 5 year holding period. And then at a recap event, you'll have the opportunity to liquidate that equity in full or in part at a handsome return. Occasionally you will see that, depending on the buyer, that equity vests over time, or they may have some type of earnout or holdback where they hold back a portion of the cash at close, and that's paid out to you over the first year to 3 years post-sale, predicated upon you maintaining EBITDA, because they want to make sure that you keep your foot on the gas and the practice continues to perform post-sale. But you're seeing very aggressive, very clean DSO deal structures in the OMS space comparative to your peers and some of the other specialties in general dentistry.
Okay. So because that sounds like a higher cash closeout, than we've heard from others, saying that some say it's like 20%. You're saying is it pretty standard to be 70 to 80%?
I would say the norm is around 75% among the most aggressive DSO OMS focused buyers out there. Now look, if you're looking at an offer from a general dentistry platform, those deals are going to look more like general dentistry deals look, where you're talking 50, 60% cash, maybe a joint venture retained equity component, and then a holdco component. There are some smaller, more startup OMS focused DSOs or multi specialty focused DSOs where their deal structures look a little bit more like general dentistry platforms, right? They might be somewhere in the middle between what a general dentistry deal would look like and what an OMS specific buyer's deal structure may look like. I think a couple of the guests that you had on previously, their experience is more anchored to the general dentistry space. And they were kind of speaking from that perspective because they're not as familiar with the OMS market and how these deals are structured. But no doubt, we've closed multiple deals over the past year with 70 to 80% cash at close and EBITDA multiples in the 8 to 10x range.
Okay. And then can you just speak, do you deal with the component of the sale that involves like, the OMS working for X number of years at a certain rate? Like what does that usually look like?
Great question, right? I mean, it's a rare day, especially in the OMS world, that you can monetize your business at an elevated multiple to a DSO and walk at close, right? There's almost no scenario where you can just sail off into the sunset after you sell the business. Most DSOs are looking for a 5-year post-close commitment, right? If you want to maximize demand, marketability, and valuation, ideally it's a 5-year commitment. Now, that doesn't mean working 5 years at your current clip. You will have the flexibility typically to cut back chair size so long as you backfill your productivity with associates. So there's quite a bit of autonomy and flexibility there. The minimum commitment that DSOs typically look for is 3 years. So somewhere in that 3 to 5 year range. A lot of that's going to depend on how dependent the business is on you from a productivity standpoint. Like if you've pulled back from the chair and you're only working a day a week and you've got multiple associates producing most of the revenue, then you might get away with a 3-year commitment. But if it's a single doc business or a 2 doc business where at least 50% of the revenue is coming from, the productivity of your 2 hands, likely you're going to need a 5-year commitment to maximize demand, marketability, and valuation. Comp can vary from DSO to DSO. I mean, on average, comp is going to be somewhere in the 32 to 32.5% range. That's 32 to 32.5% of your individual productivity post-sale.
Got it. Okay. And I mean, you bring up associates. If there's a doctor, an owner who has associates, how would you create alignment with associates in the context of pursuing a sale?
This is probably the trickiest thing that we deal with on a daily basis, especially when we're talking about, larger practices, multi-doc practices, where you either have associates or minority owners. And, how do you get them to go with the flow when you want to monetize the business in the DSO space? And I mean, the answer is it depends, right? In some scenarios, the associates are going to be like, hey, look, as long as my comp and my benefits are same or better, and you reassure me that I have a job here, I'm going to sign on and I'm going to stay long term. That's likely an associate that has no aspirations to pursue ownership. But occasionally we have associates that assert themselves. They maybe wanted to buy your practice, or they were thinking about starting or acquiring another office, and they say, hey, this deal likely can't close without my participation. Therefore, I want to be compensated for that. So there might have to be some type of on-ramp to equity for that associate, whether that's equity given by the practice owner or the DSO or the 2 in combination, or there may have to be some type of monetary incentive, what we often call a retention bonus, that's paid to the associate over the course of time. So maybe you have to set aside $250,000 of your cash at close and pay $125,000 a year to your associate for 2 years post-sale, contingent upon them signing a 2-year post-close employment agreement in order to get your deal done. But I will say that associates are becoming a much larger talking point when we're talking about monetizing a large OMS practice with multiple providers. You're going to need them to go with the flow, or you're likely going to have a problem. And it's going to impact the marketability of your business, the value of your business, or both. And we have had some deals more recently where high producing associates have kind of held the deals hostage. So you need to be thinking about, how are you going to handle that conversation when it comes time to notify your associate that you've decided to monetize your business in the DSO space. And we do a lot of planning with our clients early on in the process before we ever go to market regarding who are your associates, what are their aspirations, what conversations have been made, what promises maybe have been made, and how do we think they're going to react to the announcement that you've decided to affiliate with the DSO, and how may we need to be prepared to incentivize them to go with the flow and stay on post sale.
Yeah, that's helpful to hear. So if you are a practice owner pursuing a DSO affiliation, what would be your keys to maximizing your outcome, the value of your practice before you go to the sale?
So we often like to talk to practice owners, 2 years out, 3 years out, 4 or 5 years before a sale, so that we can get to know them, understand their why, right? Understand why they're looking to potentially monetize the business in the DSO space. Do an EBIT analysis, do evaluation, and quantify, what levers do you want to pull as you approach a sale to make your business more valuable, more marketable, more profitable. So it's great to plan early and often, get educated about what drives value and demand so that you have the time to reverse engineer the outcome that you ultimately want to achieve. But the name of the game is increasing EBITDA and reducing key man risk. If you can do those two things, that's going to make your practice far more marketable and far more valuable. But there's a lot of mistakes that we see doctors make when they approach a conversation about selling to a DSO. First and foremost is responding to an unsolicited offer. Every DSO has built a marketing machine and typically a business development team that is designed to do a deal in the dark, right? To get in front of you without proper representation and to start what may seem like a casual conversation that turns into an LOI, that turns into a closing relatively quickly. And if you have not created competition for your practice, a multiple offer situation where you have run a formal blind bid process and talked to multiple buyers simultaneously, you run the risk of making a lot of mistakes. And that is, selling to the wrong DSO, right? The DSO that was not properly aligned with your aspirations and your goals. And I don't know how you would have perspective on who the right partner is if you've only talked to one buyer, right? So it's really, really important that you meet all the players in the marketplace so that you have perspective and can choose the right partner for your practice, because who you choose as your partner is as important or more important, in my opinion, than the valuation. Yeah, everybody's going to go, eat a steak and have a bottle of champagne and celebrate on the day of closing. But what does it feel like 6 months later, a year later, 2 years later, when you're waking up in the morning, getting dressed, about to drive into the office? Are you dreading going to work? Or are you still happy to go to work? And how much has your practice changed in the interim, for the worse or for the better? So you've got to have perspective on the options available in the marketplace to make sure you find the right partner. Two, you've got to create that competitive environment to create leverage to negotiate the most favorable economic outcome you can, right? To negotiate the highest valuation you can, and to ensure that you negotiate the most attractive deal structure possible. We talked about how impactful EBITDA is on valuation and the economic outcome. So ensuring that you've got somebody with a really, really strong pedigree to defend your EBITDA and present your EBITDA in the most favorable light is going to be critical to making sure that you maximize the outcome. And then just paying attention to the details, right? There are a lot of nuance involved in these deals. And from deal to deal, the structure can vary pretty widely. And there's a lot of details that entail not only what is the cash at close going to look like, but how are you going to be paid along the way, right? What is your compensation going to look like? What are your benefits going to look like? And then what are your rights at recap, right? Are you going to be able to liquidate equity? Do you receive the parent company multiple, or is there a cap on that multiple? Is it pre or post management fee? There's a lot of details that you have to understand on the front end that are going to play a major role on the back end when you eventually get to that second bite of the apple and hopefully have, a very meaningful secondary liquidity event at recap.
Yeah, that's huge. And I'm sure the vast experience you have, selling and being a participant in so many sales is very helpful to your clients. I mean, I assume maybe you could just briefly touch on how your role would work financially. Do you charge a flat rate? Is it percent of the sale? How does that work?
So typically, to do an EBIT analysis, do evaluation, unpack your why, get to know you, get to know the business intimately, and like quantify what is your business worth? What are all the options available to you? We charge $2,500 to do the valuation. So that's well worth the investment. You learn a ton about your business, the marketplace. We can even do some cash flow illustrations to show you, if you sold tomorrow at this valuation, what are the most common deal structures out there? What would your cash at close look like? What would your ongoing annual income look like? And then hypothetically, what would the second bite of the apple at a recap look like to get you fully educated on this space, the options, and how it pertains to your particular practice? If and when it's time for us to go to market, at that point in time, we would sign a listing agreement authorizing us to represent you. That listing agreement outlines our fee. We are paid a success fee, a commission at the point of sale. And that commission can vary from 5 typically to 7% of the enterprise value of the practice. So if you're going to pay me 5 to 7% of the deal, that means that I have to juice the valuation at a minimum by 10 to 15%. On average, our clients are going to see a lift on valuation of 20 to 25% comparative to if they tried to navigate the process on their own and talk to the same buyers that we're putting the practice in front of. And like I said before, that comes from creating a multi-offer situation and leveraging that competition to get credit for your full EBITDA, and then maximizing the multiple that applies to that EBITDA. But like I said, even more important than that, it's creating that perspective and that optionality to find the right buyer. So it's very, very easy for us to cover our commission in regards to running that blind bid process and significantly garnering a premium above market valuation for the practice. But we get paid when you get paid. Let's put it that way.
Nice. Yeah. Which sounds like a great setup. I mean, it sounds like you're definitely motivated to get your clients the best deal, to hustle to find the best situation out there. And I'm sure just the experience you have can help your clients avoid bad deals and know a little bit better what it looks like.
That's as much of it, right? Is getting a good deal, but also staying away from the bad deals. And, playing in this sandbox every day, we hear a lot of the water cooler talk, right? We know who's healthy, who has money, who's over levered, who's not, like who's in the position to not only be aggressive in bidding on your practice, getting you a good offer that they can actually close on, but who's also financially healthy and has a strong probability of getting to a good outcome on the equity component, that second bite of the apple at recap. That's really, really important.
Oh, yeah. So huge. Well, this has been really helpful. I appreciate you running through all this. If there are listeners who want to continue this conversation with you, how would you recommend they get in touch with you?
Great place to start is our website, dentaltransitions.com. It's got a lot of conversations like this, articles, podcasts, webinars, but you can text me. I always give out my cell phone number. This is what I do on a daily basis is talk to large practice owners, get to know them, and decide, does it make sense to do a deep dive? Does it make sense to do evaluation and start walking down that path? My cell phone number is 512-660-8505. You can also email me at Brannon, BRANNON @dentaltransitions.com. We start every conversation with a confidential 30-minute discovery call, really casual, just get to know each other. And, unpacking the why, where you're at in your career, a few metrics on the practice, and decide, hey, does it make sense to make the investment, do the valuation, and start working towards reverse engineering whatever outcome you want to achieve.
That's awesome. Well, that's a great service. And appreciate your time. Appreciate kind of enlightening some of our listeners and giving us a little more wisdom, because these are such huge decisions, and like you're saying, it's there's a lot more at play than just the initial payout. There's years of work, and it's a life-altering thing to sell your practice. So why not give yourself the most research and background and help to do that?
I only have the opportunity to do it once, right? So you got to do it right. And we're big on coming at it from a very objective perspective. That's the beauty of the fact that we also do the doctor-to-doctor traditional practice sales. Like, we can give you that perspective as well, right? As a counter to the DSO perspective and get you fully educated. But I appreciate, Grant, you having me on. And
thank you so much for listening to this episode of Everyday Oral Surgery. For more information on these podcasts, please visit everydayoralsurgery.com. I love feedback and would be very grateful if you would reach out to me via my email, grantstucki@gmail.com, and let me know what you thought of this episode. Or you can text me at 720-441-6059. Additionally, if you have any topics you'd like to hear about, or if you would like to be a guest on the podcast, please email or text me. I found many of my interviewees through people who have been contacting me and have been listening, and I've gotten so many great ideas for more podcasts, and that's what helps keep the podcast rolling. So I really appreciate you making that extra effort and helping me out with feedback and knowing what to do next on the podcast. Thank you so much.